Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This is a chart that has timed some of the most important secular trends in stock market history. It's the Dow to gold ratio. Historically, gold has helped investors protect themselves against an overextended financial system. It has protected investors against very difficult economic periods of stagnation, stagflation, deflation, recessions. You can see here, for example, 1999 to 2011, a well-known period of economic stagnation where stock market performance was virtually flat throughout that 15-year period. Gold was an extremely great hedge against that type of market environment throughout that decade. Of course, you can see the Dow to gold ratio going down throughout that period, signaling that gold was moving higher. And very similarly, throughout the 1970s, you can see here in 1966, the Dow to gold ratio making a beautiful top before, again, a 10-15 year period in the stock market where performance was virtually flat as gold was rising significantly. Now, if we fast forward to today, you can see the S&P 500 is testing that very line of resistance that we tested in 1999, that we tested in 2018, right here at the top of the market in 2018, right before 20% drop, and then eventually the COVID crash. And 2021, right there, December of 2021, marking the top in the market right here before one of the most difficult macro environments in modern financial history. And here we are again, testing that line of resistance. We're just below it. So the question remains, are we about to see a rollover on this ratio, signaling that we are indeed heading into a period of economic stagnation where stock market performance is likely to be flat, if not even negative, and where we should be thinking about hedging ourselves? That's exactly what we're going to talk about in this video. We're also going to take a look at the technicals on the stock market, some of the important developments that we've seen over the past couple of days. We're also going to be taking a look at the technicals on the S&P 500, discussing some of the important developments that we've seen over the past couple of days and where we're likely to head in the next couple of weeks on the S&P 500. If you are new here, don't forget to smash that subscribe button because we make these videos multiple times a week covering opportunities in the stock market, covering what's happening in the economy, how that relates to the stock market, and whether or not we can find opportunities. And of course, smash that like button if you enjoyed this episode, because it does really help push out our videos to more people. So it is really appreciated. Now, without further ado, let's get right into it. Okay, so back to this chart that I find extremely visual and compelling of the Dow to gold ratio. We can quickly identify an important price channel right here. You can see if we capture all of the very important bounces and we take it to the top of the range, we capture these resistance points as well. We have ourselves a beautiful technical structure, both on the longer term where we have this bearish structure on the Dow to gold ratio telling us that we're in this secular period of stagnation ever since 1999, where the tech bubble burst 2008. And then we have this shorter term bullish structure here that we formed since 2011. It held as support here in June of 2022. And so we're here at crossroads between a resumption of this secular period of stagnation and a breakout that would actually look a lot more similar to perhaps something that we saw in 1995 here before the tech bubble developed. Now, I'm not saying we're heading into another tech bubble, but perhaps the end of the world is not imminent, or at least not as imminent as some people think, right? Let me quickly explain. In order to break this trend line, the market needs to be convinced that we are heading into a period of stagflation, right? Like the 1970s, where inflation is going to be persistent and growth is going to be muted. That's what happened in the 1970s. That's why we saw this beautiful secular downtrend on the Dow to gold. Or the market is convinced that we're heading into another major period of deflationary stagnation, just like we saw throughout 2000 all the way to 2011, where we had very strong deflationary forces, very, very low growth, extended periods with elevated unemployment, That's what led to this secular downtrend. Now, if you have the time to head to gameoftrades.net and take a look at these two articles here. The one we posted on October 19th and October 12th of 2022. Both of these go through step by step why the macro is not telling us that we're heading into an environment that looks similar to the 1970s and 2000, at least not imminently, right? Perhaps a couple of years down the road, perhaps 3-4 years down the road, we'll be in this type of very aggressive environment where gold will be an essential hedge. But in the very near term, in the next year and a half, it doesn't seem like this is a scenario that we should expect. When you look at some of the key components in inflation, whether that's using the largest component in core CPI, shelter, you can see it's rolling over, or you use the Fed's own indicator of trend inflation, it's also rolling over. It's been an incredibly accurate predictor of inflation turning points. It doesn't tell you that we're heading into an environment where inflation is likely to run out of control as it did. Perhaps it will run out of control, but in the near term, it looks like it's rolling over, and we should expect this type of period in the near term where the Dow to gold ratio was actually going up throughout these periods, right? You can see 1969 to 1971 was moving higher as inflation was coming down. In 1974 to 1976, the Dow to gold ratio was moving higher as inflation was coming down. And then for the argument of the 2000 to 2011 period, this was when earnings were moving down very significantly. Growth was extremely low, and according to the work that we posted on this article, that's just not something that we should expect, at least in the near term. Now, that's precisely why on the 29th of June, we flipped on gold. While we were very optimistic on gold throughout the first half of 2022, heading into a very tough market environment where the Fed was tightening, the market was overextended, gold was a great hedge throughout 2022, but much less so in the second half. And that's really why we flipped on gold back in June here. We have a model that helps us understand how gold is valued relative to other parts of the market. And you can see this model right here was telling us that based on the 10-year real yield and the dollar, gold was actually very overvalued. This was where gold should have been back in June, according to our model, and this is where gold actually was. Now, a big part of that was the war in Ukraine that created this premium around gold and why it was very resilient to the macro environment. But since then, since June, we've seen gold catch up to the downside. And a big reason why gold has actually underperformed the market significantly since June, right here. While it was a great hedge in the first half of 2022, it's been a very poor performer throughout the second half of 2022. So that's very interesting to observe. Now, our opinion on gold could change on a dime. It's a very powerful asset that hedges you against difficult macro environments. And it's really not impossible that we'll be heading into one of those within the next year or year and a half. The moment we think gold is going to be a great asset to be invested or even to hedge with, we'll be including it in the model portfolio, which for now is currently not the case. Now, from a technical standpoint, watch this, right? This is a very important line. If it gets broken, right, we'll be paying attention to that because that's the market, that's price telling you something about this channel. It's telling you, hey, we're no longer in this period where the stock market is outperforming. We're breaking down, perhaps moving down a lot further than current levels. And inversely, if you're a doom and gloomer, you think it's the end of the world and you see the Dow to gold ratio break out here, perhaps consider changing your opinion. Perhaps that's the market telling you we're not heading into the end of the world just yet. Now, short-term technicals, S&P 500 still trending within this price channel, but it does seem that the momentum, at least in the short term, is trying to get confirmed here. We're not getting a bearish crossover. The S&P 500 is holding above some of the key levels here. This was the level that we identified really as the short-term bullish structure in the last update that we posted on gameoftrades.net. It held that level and it seems to be resuming higher. So important level to watch here is this downtrend line that it got rejected at here in September. It got rejected in October, right before the Fed meeting. The important data point to watch out for this week is the inflation number. CPI, after disappointment throughout the last few months, it's been dragging the market down lower and lower. That could very well end up being the case again today, in which case we'd break this level and head down potentially to 3,400 points and bottom out at this level of support. Now, it doesn't seem like the bond market is expecting that right now. If we take a look at the 10-year yield, you can see we had a breakdown of this short-term uptrend line. We're retesting it. It looks like the MACD is fading here. So it doesn't look like the bond market is expecting this massively hot CPI. And I can show you a couple of examples. And right here, these were two hot CPI readings back in June. The May CPI release that was released in early June, and then the August CPI release that was released in September. Both of these had yields moving higher quite aggressively here leading up to that CPI reading. Here it's perhaps a different story. Now, of course, the market could always be wrong and get a spike like we did, for example, here in June. That triggered a pretty aggressive move down in the market. But if you continue to see this technical setup play out, where we've seen yields move down, lose a lot of momentum, break down, and potentially reverse and move back down to 3.5%, if that happens, you're looking at a strong market throughout that period, where the S&P 500 could very quickly retest the 4,100 point level, retest this trend line. So those are some of the key developments that we're looking at, some of the key releases we're looking at. Of course, we'll be updating you guys as we see new developments on gameoftrades.net. We recently made a new addition to our model portfolio last week. So if you're interested in taking a look at that, don't hesitate to sign up to the free trial. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, don't forget to smash that subscribe button and click on that like button if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.